Okay, great. It's always good to be here and fun, and we had a nice dinner last night. We talked about a lot of topics, but first of all, I would like to, if anybody's from Wilson Sonsini here, I want to thank them for the breakfast burritos. We really need that to be charged up. So thank you for that. So I sketched out a plan for the M&A while I was riding public transportation. Apart from Coma. And so, you know, liberals don't ride public transportation, that's for somebody else, but I've got a really good outline here. So we'll go over that in just a few minutes, but I think for the audience, and I can only see one person with their name on, but let's see, we'll go ahead and give maybe a brief 2-minute introduction, and then we'll go on. I'm going to sketch out the whole framework for this. So Chris, why don't you go ahead and give us maybe a 2-minute summary of your background, but not your third grade teacher or something like that or whatever. So
unless she was really nice.
Yeah, unless she was really nice and you got married to her or whatever.
Nice to see all you guys. My name is Chris Anci. I'm currently in New York City. 30 plus years in financial services. Started my career way back when in Bankers Trust. Fortunate enough to get on a small team building 40 Act funds. I then ran my own broker-dealer for about 15 years, which was both sort of a trading operation and also a mutual fund administrator. I wound that down a couple of years ago, and then I spent the last 8 years working in a family office for a real estate group here in the city, where we were basically taking care of obviously some of their personal affairs, but also managing a portfolio of non-correlated investments for them, particularly in private equity, in order for them to hedge what is now sort of taking place a little bit in commercial real estate. And that's about it in a nutshell.
Great. Now, who's next here? I think there's a Greg Carpenter and a Serge, so I'm not sure which one is which. So maybe
go ahead.
For your help. Okay, Greg. Okay, why don't you go first, because part of the screen you're on top there.
Oh, me? Okay, sure. I'm Greg Carpenter, and I have a small M&A advisory firm. We focus on privately owned family and founder-owned businesses, and strictly just M&A, mainly sell side. We do a little buy side. I've been in the business since 1985, and we tend to focus more on manufacturing, distribution, and for some reason skilled trade contractors. They keep coming to us, just doing the M&A services, so valuation, a little bit of consulting to help prepare companies for sale, and of course packaging the business and going out to market and getting it sold. So we tend to focus on companies that are between 10 million and 100 million revenues. We stay in the lower middle market. That's where we know what we're doing, we think, anyway, so far. And so that's about it for me.
Okay, is that Serge there? I can't tell because you have no name on your thing. Go ahead.
Strange. Good morning, everybody. Thank you, and thank you, Marty, for organizing this event. Serge Jonnaert with the Merger Company. We are a boutique AI-powered M&A advisory based in Southern California, actually a small beach town called San Clemente. 38 plus year tech executive, worked anywhere from small startups, several startups, as well as large enterprise entities. Had 2 exits of my own and went full-time into investment banking 6 years ago. Worked for Quorum Group until the beginning of this year, and facilitated 14 deals in the last 5 years. I operate mostly in software technology and medical devices in the US, Europe, and the Middle East. Do quite a bit of work in the Middle East, also in the lower middle market. So.
Okay, that's just great. You know, my background is on LinkedIn. I think I'm now up to 190 views this week, and maybe that's, you know, as I said, because I'm writing the blog for the USC Trojans. said that yesterday, if you guys listen, or maybe it's my HBS class secretary that, I've been doing for the last 15 years. And actually notes are due tonight, so I gotta do that, keep in mind. But also, because IvyFON has brought me about a dozen just last night, so that's a great deal. So, in the M&A environment, I've got about 5 or 6 topics. One is the overall environment. Then we've got what mergers make sense, the types of ones, the consolidation, the valuation techniques, and then the due diligence teams, as well as the due diligence requirements. But I think I'll just cover the overall one because I don't think Goldman Sachs or somebody's on here. But in terms of the overall environment, perhaps the most topical one now is the potential acquisition, the offer at of U.S. Steel by Nippon Steel. So there's one that's, obviously Japan's one of our closest allies, and they received first. U.S. Steel received one from Cleveland Cliffs, but there was a blowout offer from Nippon. It's $55. Stock's trading $35 to $38 right now, and President Trump, Biden, and Harris have all opposed it. But what's happened is that Cyprus has decided to have them refile, so they got another 60 days or so, and it's going to be delayed until after the election. But here is the key thing. I'm not sure why, but United Steelworkers are opposed to it. But there's the Mong plant along the river there. I think it was built in the 1890s or something, the steel plant that will definitely be closed down if the Cleveland Cliffs guy buys it, and there'll be thousands and thousands of steel workers lose its jobs. But Nippon's offered, they said they'll put something like $1 billion in it. So there you have a choice. Do you want to save some jobs, or do you want to and have a foreign investment? Although they did say it'd be majority U.S. ownership on the board, and so we'll see what happens on that. But what seems to be under the Biden administration is, if it's not Cyprus, the Department of Justice, the FTC, and even the SEC seems to get involved in some stuff to mix it up. So it seems like almost everybody is being challenged for one thing or the other. There's a few fines for the big guys like the Facebook or Google's, but maybe all they're spending is like one day's cash flow. So I don't think we have to worry about that. I think what we want to look at, is, in your view, what types of acquisitions make sense? Is it tuck-ins, strategic, vertical, horizontal, roll-ups, consolidations, and and then of course we have some spin-offs and stuff. So maybe you guys give a brief idea of your own experience, and tell me about what you see good, bad, or ugly about those. I guess what I think I'm going to do to make it easy. We're going to rotate in the same order.
Okay.
Then Greg, and then Serge. Okay, so that way that way, and then after we get to the Q&A, anybody can jump in. Okay.
So I think in terms of the overall M&A market, what we know is that 2023 was a very down year, and this year started off a little bit better, and I think the run rate is definitely for higher for 24. But like everything in the U.S. economy these days, it's just dramatically bigger, right? In the late 70s, if GM went on strike, it was a third of the U.S. economy. Today, you can have parts of the country in a boom. You can have parts of the country in a recession, and some parts could be in a depression because we're just such a large GDP player. In regards to M&A, it's sort of a very similar ecosystem where at the top end you have serial acquirers and sellers, right? You have large multinationals that are always in the market to buy revenue. Whether General Mills needs to go and buy the most innovative pet food company, or Procter & Gamble's got to pick up some product that they never even dawned on offering, And then they also look at the balance sheet and see what acquisitions aren't working or areas are a drag on their business. And then they try to divest out of them. So, and when you're looking at some of these multinationals, when they want to divest a business, yeah, I mean, it could be $1 billion, $2 billion, $3 billion a year business or more, but it's a rounding error for them. But for a private equity group, maybe a family office group or something, it's a real business for them to acquire. So I think at the top end, you know, at that large scale, I think it's going to be somewhat business as usual. And then courtesy of the Fed rate cut, they got a little bit idea what their cost of capital is going to be. So they're going to be able to sort of work that out. In regards to some of the stuff that we work on, we typically are Series A buyers, right, of small companies, and we finance them. We're looking for, you know, post-revenue companies, $5, $8, $10 million worth of rev, and we look to get them out in a couple of years at a decent multiple. That's been a little bit of a logjam because there hasn't been sort of any other liquidity events to give people the gunpowder that they need to order by somebody else. So we're hoping that logjam sort of breaks a little bit going forward. And in regards to the steel conversation, I think it's an interesting example because we're in a political sort of scene when it comes to steel and tariffs and sort of like, you know, repatriation of some, you know, U.S. businesses. So I think that particular deal is a little bit complicated. But by and large, I think the large scale acquisition mergers, M&A will happen. And then, of course, out there where you guys all are in San Fran, we all know that the Magnificent Seven are the seven is because they've just got a massive amount of free cash flow, right? So, you know, people are using those things, you know, that's why they're attracting all the capital in the room, and they can buy anybody and everybody that they want. So I'm sure they'll continue their shopping sprees as they see fit.
Okay, Greg?
Well, I definitely agree with your assessment of what happened in 23 and 24. Go back a little bit farther. 22 was a pretty good year for M&A, and I'm located in San Jose, right in the heart of the Silicon Valley. And since we focus on manufacturing, a lot of the companies that we work with are the various sorts of contract manufacturing businesses like precision machining, precision sheet metal, assembly, painting, testing, all those sorts of things. And if you recall what was going on there with the pandemic, we had all these supply chain shocks that caused companies to basically stall because they couldn't complete their products without the chips. And so they saw a dip in their revenues and earnings. Then as the chips started becoming available again, they had all this backlog of work and they saw their revenues double. So we sold some companies at that peak where they were running double. And then a year later, guess what? They're back down to their former running. So you asked what running rate, because they satisfied the bulge of demand. They call it the COVID bulge. And so you ask what isn't working. And what we saw was not working was buying companies at the peak of the COVID bulge and then watching them float back down to half the revenue when they bought it. So I think a lot of people were kind of unhappy about that, thinking that higher business rate would go on. So what we see that is not working right now also is a lot of the contract manufacturing businesses in the Silicon Valley are dependent on the semiconductor equipment industries. So you've got Applied, Lam, KLA, and the others that make up most of it, and they've all been in the doldrums. There seems to be too much capacity in chips and a lot of drop in demand. And so all of those companies are just kind of idling along, waiting for better times. And the industry association, SEMI, is predicting that toward the end of the fourth quarter of 24 and the first half of 25, it should be returning to pre-COVID levels and everything should pick up again. So we've seen people holding their businesses off the market, or even those that are on the market not getting much activity because their sales and earnings are down to half what they were pre-COVID. So that's That's what I see from my very limited small world of the Silicon Valley here.
So I'm just going to give a brief insert on that. Many years ago, one of my HBS colleagues and myself decided to buy some small businesses. And one of them we looked at was a company actually was making high-end fish tanks for Chinese restaurants, among other things. And the guy had, unfortunately, he had hired his ne'er-do-well brother to do the bookkeeping and inventory. So I'm looking around, and he shows me he's got $500,000 of inventory there. And I says, you know, I've been to Home Depot. I know how much inventory, you know, how much you don't have that. You have maybe if you're lucky, you have $100,000 of inventory. It turns out that was the difference. It was less than 100,000 after he took a physical inventory. He hadn't been making any profit. So now, how do you sell a business that's been losing money for 5 years and doesn't have the profit? So you got to be very careful about who's hired by these places, because a lot of it's a real big thing, because they really don't have much accounting standards in many cases. But anyway,
what we usually see is the reverse, because people are making money, but they want to hide it. So their inventory gets to be a little bit bigger gap between what's really there and what's on the books, with the books being much lower every year. I've seen some companies that showed as little as a few $100,000 of inventory when they had millions. And so when they go to sell
I got adverse selection, then I guess we got to don't use a business broker. Yeah, trying to peddle you some dark. Okay.
Well, the buyer's auditor is going to figure it out, I think.
Yeah. Serge, go ahead.
Yeah, well, it's interesting you mentioned the fish tanks. I do have a cousin that got into the koi pond business, and they can't keep up with demand. So definitely something worth mentioning. No, in general, I mean, you had mentioned earlier, Cepheus, in terms of international transactions, there's definitely a lot more oversight. I had a big deal in the Middle East fell apart at the beginning of this year because of